tax loopholes, the unfair tax loopholes that venture capitalists get. So this podcast is going to be a little bit different. We're going to talk about some behind the scenes things of how Uncle Sam treats venture capitalists. So if you're looking for more startup advice, this one is not that episode.
But if you're following politics in the last few weeks, then you've heard about the carried interest loophole, quote unquote, because it's not actually a loophole.
Which has been stressing Peter out. So basically the topic is that if you look at a VC as a business,
Yep.
a large chunk of their quote unquote revenue is not taxed at the same revenue as say Codebase is.
Right.
Or the same revenue that I take home. They basically get capital gains tax rates immediately in their pocket, where Codebase, I have to pay regular corporate taxes if the business shows a profit, and I have to, when I get personally paid, I have to pay regular income tax. Whereas when Peter gets paid from Carry, there's this loophole where he gets a much better rate.
Lucky me.
So this is something that's been trending on NPR. So let's talk about it. And
it's not just NPR; it's been everywhere because it was going to be in the end inflation bill or whatever they're calling it.
Mm-hmm. And they're using it to fight global warming, things like that.
Yeah,
is how they want to.
Okay, so here's the context.
This is you can tell Peter's riled up. This one hit his heart.
Well, it hit my pocketbook now. But let's set the stage and provide the context. Okay, so carried interest. What's carried interest? So a venture fund, a private equity fund, a hedge fund, a real estate fund, anything that has an LP, limited partnership, and general partnership structure. Well, I mean, not any of them, but most of them are going to have two forms of compensation from their investors. One is management fees, and those management fees are used to pay day-to-day operations, salaries, overhead, office space, like all that general stuff. And industry standard is about 2%. So if I have a $100 million fund, then I'm paying 2% of that $100 million every year for so many years, and that's defined usually like 3 to 5, and then it will typically decline, or it'll be a percentage of total dollars invested. Anyways, we won't get on the nuances there. Point is, you're pulling roughly $2 million in fee, and that $2 million is meant to cover, like I said, overhead, salaries, etc. That's not what's up to debate. What's up to debate is the other piece, which is the performance fees. So the industry standard is about 20%. Some go as high as 30%. Some are lower, like 15 to 10%. But it's 20% of the profits of the fund. So if I invest $100 million and those investments perform well and they generate, let's call it $300 million of returns, then I return the $100 million. I'm left with $200 million, and I'm going to split that 80-20 with my investors. So I'm going to return $160 million, so a total of $260 million returned to them, and I'm going to pocket $40 million. And the way that the tax code is written, that $40 million gets treated as capital gains, not as ordinary income. Now, in other areas, right, like if I'm a sales rep and I sell some product and I get paid a bonus or a commission for selling that product, I'm not taxed on that at capital gains. I'm taxed on that as ordinary income. And so there's this debate that's like, hey, this is a performance fee. It's kind of similar to sales, right? Like a commission. You're getting paid to do your job. That should be taxed as ordinary income, not as capital gains. And private equity and venture investors and hedge funds say, well, but there's some risk that we're not going to get paid that. It's it's kind of a piece of the overall investment. Yes, we're getting compensated for our work, but there's some risk there to it too.
Okay, I get taxed on my bonuses.
So that's the debate.
And the bonus is risk. So whatever it is, it should be similar.
Yeah, and maybe it should. And that's the whole debate, right?
Okay.
Is that, and it keeps coming up. Democrats and Republicans have brought it up again and again and again. And for whatever, every couple of years it comes up. And every couple of years, for whatever reason, it gets axed out of the bill. This last time was, the senator from Arizona that kicked it out. So, yeah, look, I think there are good arguments for why it shouldn't. it shouldn't exist.
Okay.
I think there are good arguments for maybe why it should exist, right? I think if you play the math forward, right? If you're a hedge fund manager and you're generating hundreds of millions of dollars of carried interest, right? And you have to pay either 25% or 40 to 50% taxes on that. Well, I mean, that's a difference of upwards of $25 million, right? Per 100 million. No, that's a lot of money. But the flip side is you're also pocketing $50 million.
Okay.
You're not doing too bad, right?
Okay.
So do you need that extra $25 million or not?
How about this? We just flip it. The rest of us bonuses are taxed the same as how fund managers get paid with their carried interest.
Well, I mean, the libertarian in me would be okay with that because I think,
that's my answer.
Lower taxes are better. But
are you a libertarian?
I definitely been more libertarian.
Okay.
But the point being is like, well, we're not going to change that. That's not realistically going to happen. So what we should do is
make it consistent.
We should make it consistent. Here's the thing on the flip side. If you're a venture investor, let's say you're a brand new venture investor, right? Let's say you're maybe like a minority emerging and manager venture investor, right? First fund, whatever. It's very unlikely that you're going to be able to raise a very large fund, right? So maybe your first fund's like $10 million, right? You're a great investor, but maybe you're a minority, maybe you're an emerging manager, like whatever, like the cards are stacked against you, like it's harder to raise that first fund and your second fund and maybe your third fund, right? So you've got these relatively small funds. On a $10 million fund, you might be pulling a couple $100,000 in management fees per year. And with that couple $100,000, you got to pay your salary. You got to pay your analyst's salary, right? If you have one, you got to pay your legal bills, your accounting bills, like your office, your overhead, your travel. You're like, you're probably like a good fund manager probably left a job where he or she was making 100 to 150,000, right? Minimum, maybe more than that, 200, 250. And now they're going to take like a massive pay cut to set up this fund. And they do that because they're hoping on the back end that their investments will perform well and they'll get this carried interest. And that will make up for like the income differential. And so it's super meaningful, right? And, let's say they take that 10 million and they just have a killer fund and return like 5x that fund. So that's $40 million. They're going to split that 80-20. So that's $8 million coming back to them. Well, like $8 million sounds pretty good. But if you got to cut half of that out in taxes, now you're talking $4 million. And then you're taking that $4 million and you're spreading it out over the course of 10 years. So, really it's not that much money at the end of the day, right? And if their returns aren't that good, right, you just take those numbers down even more. So the thing there is that, and there's some risk, right? They don't know that they're actually going to get that. And it's going to take them like 10 to 15 years to generate that kind of return. So the challenge there, right, is that if you're an emerging manager, or a minority, you might look at this and be like, I've got this really great job today where I'm making like $250,000 a year because I work at Google as an engineer or a product manager or whatever. And if I leave and I start this other fund, I'm going to like have to go from 250 to 300,000, whatever a year to like 75.
Okay.
And then on the back end,
rough life, Peter, rough life.
And then on the back end, maybe if I'm successful, I'm going to get a few $1 million, but it's going to take 15 years to get there. And look, like I'm not saying like feel sorry for them.
I feel sorry for you, Peter.
But here's the problem. Here's the problem. If the emerging manager, especially if they're a minority, they look at that and they say, you know what? It's way too risky. I'm not going to do it. Then what happens? We don't end up with emerging managers, particularly minorities. And minorities and women are more likely, they're 50%, they're 2x more likely, sorry, not 50. Women and minorities are twice as likely to invest in other minorities and women-run businesses than white men.
So you think that,
and so if we don't,
you think that minorities and female fund managers are not going to even become fund managers because of the tax rate?
I think there will be fewer of them.
Because of the tax rate, they're going to say, when I look at everything, this tax rate is the one thing that's going to make 10, 20, 30, 40% of them fall out.
Potentially.
Really?
I don't know. I think it's one of those things that could,
Okay. So your
it's a disincentive. And anytime you have a disincentive, like fewer people are going to do stuff.
If we pull out your confirmation bias, your main thesis that I can wrap my head around is you feel like this adversely affects minority and females that are considering
and emerging managers. Emerging managers generally.
Okay, just emerging managers in general, and especially these other representation in minorities or ethnicities.
Sure.
Okay.
And in a way,
I'm not in deep enough to think about it, but I do see some parallels. Is this a bonus like income, or is this like a CEO selling their company that gets taxed at capital gains?
Yeah. And I agree with you. Like, I think it's nuanced. It's definitely gray. I'm just saying, like, there are two ways to look at it, right? There's pros and cons. And I think at the end of the day, if there are bigger returns on the back end, it's going to incentivize more people to enter the space, right? Okay. And if you cut those back, there are going to be fewer people they're just going to look at it and be like, I don't know if it's worth it. I'm going to maybe do something else.
I'm going to keep my enterprise sales job.
Yeah. Or maybe I'm going to start a company, or I'm going to, I'm going to do something else.
Okay.
And then what I think that does is it has a risk of perpetuating this, like the rich, once they've gotten there, like they don't care, right? I mean, they care, but like whether or not we take $25 million out of their pocket or $50 million out of their pocket, they're still pocketing at least $50 million. They're going to be okay, right? Like nobody's feeling bad for them, right? And at that level, nobody's like disincentivized to not keep doing it.
Okay. I think this is going to be those moments. You've said your piece. We're going to let the audience decide. I'm not in deep enough to understand. I do think there should be consistency across the board, though, whatever it is, if it's income. But then what is income? Is selling a business an income? Is that my confirmation bias, just like you've got your confirmation bias of how you're affected?
Sure.
All right. Well,
and keep in mind, I know that I just spent a bunch of time talking about like how it could negatively impact stuff. I'm also not like arguing super hard that it should be retained the way it is.
What do you think it'll happen? My guess is it'll probably get wiped out, just like every other bill, because it's a small aspect. There's larger.
Well, it's already been taken out.
Oh, already? So
it's already been taken.
It's already a moot point for this year.
Yeah,
but it's going to come up again.
It's going to come up again, and it will probably stay because the people that are making 50 million, 100 million, whatever, right? They're like, hey, Senator, whatever. If you cut carried interest, I've got $25 million less that I can donate to your campaign.
Okay.
So, your call. Do what you want.
Okay.
Right? But just keep in mind, like, you're tightening my belt, so there's just a less to go around.
Okay.
Which,
I wish we all had that leverage.
I think that is why it gets thrown in and then taken out.
Okay.
And taken out. Because, the senators and the congressmen and women that aren't getting it are like, this is not fair and we need consistency.
Okay.
Right? And those that are kind of like, well, if you want my vote.
And if you're trying to become a VC, this is something that's going to be very relevant.
Oh, for sure. You have to understand this. Yeah.
Okay. So if aspiring VCs listen to Peter, this podcast was for you.
But look, I think what is interesting is, let's say that they do take it out. I guarantee you that somebody will figure out another way around it.
Okay. They'll just start offshoring all their cash.
They might.
Set up funds in other countries.
I mean, they've so many have already been doing that, right?
Is that a big trend right now?
Offshore accounts.
Are there offshore?
I would
VC
say
funds?
a lot. I mean, I don't know the numbers, but it would not surprise me if the majority of venture funds, private equity funds, and hedge funds are set up offshore.
Is yours set up offshore?
I can't disclose that sort of thing.
Okay.
But
Crazy taxes. Well, anyways, if you want to learn more, go to venturecapital.fm, where you can like and subscribe and follow us in anywhere you want to follow us on TikTok and see our sexy dances. We are there. All right, guys.
We are.
All right, we'll see you guys for the next episode, venturecapital.fm. Make sure you give us a 6-star review, please. And you can now leave reviews on Spotify. That's a new thing that happened in the last week or two, I think.
Comment, subscribe, like us.
All right. See you guys soon. Talk to you later.